Today I'm going to be talking about how you can use open interest on heavy retail names. Overview, we're going to talk about what is open interest, a trade strategy, some chart breakdown, how you can execute this trade, like one strategy of positioning yourself, and then how I can improve this trade setup. So open interest refers to the total number of outstanding derivative contracts that have not been settled. So with this, a lot of the time you'll see high open interest on whole numbers like an AMC, for example, in like the 40s, 45s, 50s. So a lot of time you see these whole numbers be really significant and have high open interest. Unusual high open interest areas on retail heavy stocks tend to indicate price areas where retail money is long. The nice part about looking at open interest is you know exactly where they're positioned and exactly how, if the contract closes below a certain price, if they'll make money on the trade or not. The thing is, with just looking at a price action chart, you can kind of tell where retail's positions based off maybe VWAP or volume profile. The thing about open interest, you know exactly how they're positioned.
Do you mean by that essentially if the stock gets above a certain price, there's going to be people in trouble? Do you mean if it gets below a certain price, people are going to be in trouble? What do you mean by that?
Okay, so let's say price has spent some time in an area, right? And you're seeing as price is developing a time into this area, it's accumulating buyers and sellers. And then once price gets below that range, you know that buyers within that range are now stuck. They're in trouble because now they're in a losing position. And you know that based off the price action, the volume. And with open interest, you can see directly because they're buying into a certain strike. And so you know perfectly well if they're in the money or out of the money. And then how to identify retail money using Wall Street Bets, stocks on Twitter, a lot of social media sites, keyword search trends. A lot of the time you'll see these trends going parabolic, same with the price, just how recently we had Bitcoin going parabolic with also the trend of Google searches going parabolic. If you want price volume analysis, volume is coming into the intraday highs and you're seeing volume push through, showing that people are chasing FOMO, a lot of common behavior of retail buyers. And then another one, Option Hacker on Thinkorswim, you can do searches for these. And these people are the most generous people on the planet. They will give you their whole account because they do not know what they're doing.
Okay.
Variables to the setup. So these stocks have to have weekly options, and this trade setup is particularly on expiration day, so coming into Friday. Has to have high open interest on in-the-money calls. You have to have a technical setup just for having to level a risk off of and to scale into. This trade happens 1 hour before the close, and the reason to cover, which we'll go more in depth with an example, is if the strike price is hit or on the close. And then stock is in play, high R-vol, heavy in retail call buying throughout the week, and you can find that in some of the examples that we had on the previous slide.
Yeah, I really like this, and this is a good example of a clear idea of getting into a trade. Clear list of variables that's going to get you into a trade. You know what you're looking for. I can understand what you're looking for. If I were to tap you on the shoulder and you were in this trade, you'd be able to say, I'm in this trade because of 1, 2, 3, ABC, XYZ. And that's what professional traders do. I think sometimes retail traders or independent traders think that what professional traders like us do is we predict where Tesla's going to go. I think Tesla's going to go over 1,000. I think Tesla's going to go to 300. I think CIE, what's the latest one? CEI?
CEI.
I think CEI is going to go to $1.50. No, I think it's going to go to $6. I think Allbirds is going to be XYZ by the end of the day. I think, what's the other IPO that's coming pretty soon? We got Allbirds, and then we got, this is where my age is coming in. What's the other one that's hitting the marketplace? Warby Parker. So Allbirds and Warby Parker are hitting, and so we'll be trading them much. And I think the idea is, that's what people think. But what we really do is we trade patterns, we trade setups. We trade, and those patterns are made up of variables, and you can describe them, and you can decode them after good trades. And when you see them, you put on trades. And you can measure them, like we can measure things like this. This is measurable. It's measurable for you. So that is the essence of active trading. The other stuff is different. Okay.
All right, so the thesis behind this strategy, in order for option call sellers to make profit, the underlying must expire at or out of the money. So they ideally want the contracts to go from in the money to out of the money by expiration, which requires a drop in price. For these option sellers to hedge against price moving against them, they have to buy equity in a hedge. This protects them from from selling naked calls, which is a very dangerous way to blow your account up. So what they do is they buy the equity in itself to protect themselves. One way they can drop price is by selling their equity they use to hedge against selling calls. The goal in doing this is to drop the price low enough to at or below the open interest strike price for them to maximize profit. So in their eyes, by them selling their equity against the calls, they're getting their equity position, but also selling their equity is going to create supply, and it's going to likely allow price to drop. And when price drops low enough to make the contracts at the money or out of the money, which maximizes profits in them selling the calls. So that's a win-win for them in both those scenarios.
I'm curious, who'd you learn this trade from?
I kind of just have been looking into open interest and options like on every Friday and seeing which option contracts have a lot of open interest, and I'm curious of how it closes. And I've noticed a lot of times when there's a lot of in-the-money option contracts and price is just below it, they'll close it below to bag all those call buyers.
Okay, good.
Okay, so first example, this is on September 10th on Friday. And you can see open interest 23,000. It's much higher compared to the other open interest, and you can see also the volume on that strike price is extremely high, right at the 50. And so this is important coming into that Friday at the end of the day. So as price action developed throughout the day, we see we're holding over VWAP. We're consistently coming up to this 5160 area, and it's like kind of like false breakout. No real volume follow through. And throughout this day, there is call buyers accumulating, hoping for that end of day squeeze. But then once price starts to come within the last 30 minutes of market close, when those 50 strike prices are going to become important for those call sellers, we start to see a drop, and we see a reclaim back to the range, and then which is a good spot to short from a risk reward perspective. And then we get a drop right to that 50 where that extremely high open interest is. And when it closes at or below, those call buyers are back. Execution.
Was there a technical level that you're also seeing there?
Oh yes, are you talking about the 5078 level? Where
I don't know. I just remember in your variables you mentioned there's a technical level that we're also going to use.
Oh yes, the option open interest contract price. It's that 50 level where price came right down into at the end of the day.
No, is there technical resistance that you're also using to short this into 50?
Oh yeah. So with the technical level I was looking at was break VWAP and then come back up into VWAP, and that which is
so you're using intraday VWAP as a technical level.
Yes.
You're not using a daily resistance area.
No, in this particular case, this trade is in the last hour. So for me, I'm using the intraday levels as a more important variable.
VWAP is the green line.
VWAP is that green line and then eventually turns red. Yes.
Interesting how it finally, to me, it finally got below VWAP for the first time during the intraday.
Yes, and it held on stronger volume. And then we got that interesting retest of that previous support, now resistance, and then we get the curl over. So for this trade, I was starting to scale in really small size into the close, anticipating the move into 50. So you can see I had some short executions, scaling out a little bit. And then once I got the confirmation of the break below VWAP on high volume and the retest of the intraday range, that's when I started scaling in with much bigger size and conviction.
What's your stop?
My stop in this particular case, my stop was $5.90 or $50.90 in this case. Because this trade is based on a time basis, this trade should work right away. It should work within the last 10 minutes, last 15 minutes. So if this trade would have got back a VWAP and held for longer, I probably would have cut it there, but my hard stop was at $50.90. And then first cover into that new intraday low, which I believe was like a 10th position, and then I took off all but about 10% into that 50 level, which was my reason to cover target. And then I just held like a small position just in case maybe we got a little flush lower, but I just covered the rest of the position on the close. Another example, BBIG, September 10th. Open interest are really heavy on those 11 calls, 17,000. Okay, here we see price consolidating for generous amount of the day. We get a false breakdown right about at 1080. We get a retest of VWAP. And then this was really important and something that has a lot of edge if you can time it correctly. But we get this bust above VWAP, so false breakout, and then slam down quickly, which was also like some sort of flag break. And then we also got a retest of that small range, and we were unable to reclaim. We pull into the 11 strike price level, and then we just fade from there, bagging the 11 calls.
All right, great.
It's PLTR. This was pretty recent. This is September 17th. So we recently had that important technical breakout. It was like a multi-month breakout out of a longer-term range, and the PLTR is one of the ARC names, so it's generally heavy in retail. So a lot of people are chasing this breakout, and we got a multi-day continuation move. And then coming into the Friday, we see that the 29 and 28 calls have pretty high open interest. So that's important to look at when you're coming into the Friday expiration.
All right, I gotta say something here. So I don't want to be too dramatic, but just between me and you, I don't really like this trade. I don't actually like the very specific trade. I don't know how much money you can make in this trade. That's like my initial reaction. My initial reaction is I don't know if you should be spending your time on this trade. Having said that, there's a lot of things in this that I actually really, really like, and I suspect that you're onto something. It's just not what you think it is. So, number one, you're being creative. I love that you're being creative in developing a trade. That is an incredibly important characteristic for successful traders. Right? You're taking what you've learned in other areas, perhaps from the traders out on the floor, perhaps a little bit from us, humbly, perhaps from some of the other guys here, and you're creating something. You're doing so in a way that's professional. You had really good variables for how you made the trade. It was clear, it was concise, I understood it. Other people watching will understand it. That can be repeated. You did a good job telling me right away where your stop was. So you're constructing a professional trade. And it makes sense. It makes sense that this could happen, and maybe you'll continue to measure this and you'll come with an edge. I do think the problem with trades like this is what? I'll answer for you. The problem with trades like this is that I suspect you're gonna have a really high win rate, but you have to be really careful when you're wrong, not to lose too much money, and how you handle that. So I'd search for that. I suspect that you looking at the way options are priced is going to give you lots of really potentially great trades for you in the future. I don't know if it's this very trade, but I like you doing that. And I think a lot of times it doesn't really matter. It's not as important. It's important that you're starting. Like you're on a good path. You're starting and on the right way. I would encourage you to keep moving in that direction. And I think if you even talk to guys around you and introduce them to the trade that you're making, again, I don't think any of us are going to make a lot of money on this trade, and I hope I'm wrong. But I really don't think we are. But I think you're onto something that'll just show itself in a different deviation. that could be very, very promising. Does that make sense?
Yes.
I just don't know that trading for 70 cents in the last 30 minutes of a trading day is where you're going to make enough money. Now, maybe you're going to tell me, well, this is just one example, and I've got better examples, and there's going to be better trades, to which I'd say to you, then let's just make those trades, and let's not make this trade. But that's good. I mean, there's some good stuff here.
Yeah, I understand. Like this, so this trade ideally will have a really high win rate. It's just knowing when I'm wrong and like that risk reward perspective you're talking about, because you do need multiple variables to align for it to work correctly. And another strategy, which you just mentioned, is you can take the same trade setup but in a completely different way, which is in the last slide where I when I talk about the improvements for this. Yeah, but for now, so PLTR had that 29 level had extremely high open interest, and then coming into the end of the day, trendline break failed to reclaim the previous range, and we closed below 29, bagging those 29 call buyers. Okay, how to improve this trade further? Doing basically the flip of this trade, which would be going to the long side when there's high open interest in the money puts. So it's just the same strategy, but it flipped. That's one way. And then back testing. This is something I haven't got into, but I strive to, is figuring out if there's more edge when the open interest is compared to the average volume and float size of the particular stock. And then the odds that options in the money with high open interest on Friday end up expiring out of the money based on ATR and strike price. And then here's the option strategy. So not even trading equity in this perspective, but trading out of the money credit call spreads Wednesday or Thursday if the premiums are high enough, with the idea that it closes, they get bagged and close below strike price. So basically you're playing the same side as the call sellers in this case.
On Rivian from this week, the 15th. So overall expectations in trading, forcing your expectations is going to skew positive expectancy on any single trade or system. It's really specific now. We built a bunch of execution strategies within these breakouts to manage our expectations based on a few variables present themselves off the open. The main ones being daily and intraday price action, tape, volume, and market context in the main indices and leaders. So based off how those play out intraday, we're going to manage our expectations differently. And the question we're asking ourselves is how do we stay involved in the most aggressive scenario while managing our risk? And to do that, we use market context and the breakout market breadth data that I'll just briefly mention later to tell us when to risk on or risk off. And the combination of the execution strategy and the breakout market breadth mitigate our risk in our losing periods when the environment shifts. And when we're wrong intraday, the execution strategy helps us mitigate the risk there.
And you're doing this as a team, right?
Yeah.
So there's somebody on the team that's feeding you market breadth data and responsible for feeding you market breadth data?
Yeah, we built it together, and now like each of us are like responsible for a different portion of it.
Okay. And you and another guy are more responsible for strategy, but there's people coming together for this trade in real time to make it better.
Yeah, definitely.
This is an example. We call team trading. We call it, and with team trading, there are joint accounts. This is a joint account trade. You're doing this with other people. Okay.
Yeah, this is actually on 2 accounts.
This is a joint account anti-playbook trade.
Yeah, yeah, it is.
We should have all of you in here getting some lashes. All right.
So this is the SWI daily. Just going to mention real briefly, gapping into 200 and the 10 and 20, so short term and a big term moving average. Q's daily, very similar, except it's relatively weak. It's under the 200 and gapping into its shorter term averages.
If you want to learn 3 more real-world setups that our traders use, including the simple setup that we teach all of our new traders, and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open up the free registration page in a new window, so don't worry, you won't lose this video. You can also visit tradingworkshop.com to register for this free intensive workshop. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
So the way we look at this is just plain market context. Our major indices are underhead, both short-term and long-term moving averages, gapping into declining moving averages, which is even weaker. So the lack of internal strength and like the general breakout numbers have been pretty abysmal.
So that means breakout should work less and breakdown should work more.
Yes, yeah, that was our first inclination. So that's what happened in the first environment shift. And so then, for market context, this part of our system, we ask ourselves, is this the market context breakouts are going to outperform? And no. Will we usually get our most aggressive scenarios with the indices, this exact market context, gapping into declining overhead and moving averages? No. So that's like a pretty low grade for market context. This is the breadth data. This part gives us an edge for a higher time frame and more environment shifts. So this reflects some of the data we track within 5-day, 1 month, 3 month, and 52-week highs to lows. It's a 4-month rolling period. Even after the environment shift, you can see the green is the 5-day. There are still momentum bursts higher, right? Even in a bear market, when things move lower, things will bounce and things will move higher. It's just a question of how can we actively manage our risk and focus on the things that are actually working within that. So breakouts generally will not work. And so the other part of the breakout data really helps us narrow it down and be very specific to what we're looking at. This is a percentile range of a 52-week range. So if I go to like this daily right here, if you split this into 3 parts, the 75th, 50th, and 25th percentile, we basically look at all breakouts that are working and like closing higher within those ranges, and we'll formulate it like we basically put it into a visual representation. But the blue bar is when breakouts are working, closing higher under the 25th percent of their 52-week range. And we can see after an environment shift like that, tons of names have come off 50%, 70%, 80%. So that's clearly why we're seeing if breakouts are going to work. They're not working at the 52-week highs or even the middle of the ranges really now. Mid-February, they're working at the bottom end of their ranges when they're working at all. So getting very specific to know what we're looking at and what's working. So the second point, what does that mean for us as active breakout traders? The lower end of the 52-week range and shorter time frame breakouts is our new most aggressive scenario considering what is actually working in this environment. If things shift and things start working again and 1 month, 3 month ranges are holding higher, we're going to broaden our time frame again. But this is generally the data when breakouts underperform. Is there still money to be made in shorter time frame breakouts by adjusting not our execution, but adjusting our time frame and the context that we're trading? Yes. Should we be net long if breakout setups present themselves for us to manage our risk? Yes. When the environment shifted, a little note is moving base risk on breakouts down is a great idea. So we bumped it from, or downgraded it from 1 hour to half an hour for base risk, our initial risk. So just being net long in this case may not be with heavy size, but we want to be in the right frame to say, we're going to do this 100 times with this exact same context, exact same data, exact same setup. Are we going to have a positive expectancy? I think so with this system.
Does the mirror image of this breakdowns show edge?
Yeah, so late January, or January is when we really talked about this and started implementing it. We have not necessarily this on the opposite side, but we have a lot of other data like this showing us the breakdown side. And so we use that data to pinpoint what's going to work or supposed to work late January to capitalize on those breakdowns. But we saw something interesting was both dried up, like the breakouts and breakdowns in February. Interesting enough, like you obviously seen it in the action, but there's just no follow through on either side. So now we're having to get even more specific within both of them, what's actually working. Yeah, definitely was helpful.
Fading.
Fading. Yeah, intraday fading. This is the Rivian breakout setup. It's just a technical breakout. 66.5 is the inflection we're watching. And so we scan a lot of breakout names, probably most names that are setting up to breakout. And we're judging risk reward by what's opening closest to inflection. So the goal of the setup is just a setup. A setup combined with market context and the breakout data that we just mentioned. The goal of all of that is to manage our risk by only adding more than that initial 0.5 R if we see volume patterns or a changing character with the way it's trading, opposed to before, because that way we can mitigate that risk a lot tighter and expect more out of it on the short term. But if that doesn't happen, we just want to be net long if this were to break out and that day the market gapped up. What if the market is strong? We don't know how the data is going to play out off the open in the morning session. We just want to be net long if things were to break out and it doesn't give us an ad spot. And the goal is to get out majority as intraday targets and hold a little portion if things hold higher. And then this is the important part, the mistake in this, because that's kind of just a system of how you break down, come to a trade. After the market environment shifted in 2021, 2022, we scaled back risk like I mentioned, and we added our breakdown trades like you just mentioned as well. And that was a substantial percent. I think it was about 40% of January P&L, which is really big. The problem here, mistakes come in after about 2 months. December, January, the main focus was risk mitigation around all setups. Doesn't really matter what's setting up, how it's setting up. We knew what the data was telling us. There was a shift. We knew what the market context was telling us. It's not trading the same way it was before. So the only focus those 2 months was risk mitigation. And for different personalities, this is going to differ a little bit. But for me, my main strength, I'm going to trade my absolute best when I'm focusing on risk mitigation. I know not everyone is like that. Like my trading partner doesn't really want to focus on risk. He wants to focus on the reward because he trades better like that. But for me, expectations crept in on this trade, and I oversized in an environment like this, and that's going to be a massive mistake every single time. It's just because something's set up, quote unquote, nicely for the first time in 2 months. I should have caught it, but pre-market, I was telling you about some signs. But during our conversation, I talked about bumping our base risk from like, we'll just say 1 hour to like 1.5 hour. That's something I haven't done in the last 2 months. It's something I haven't done since there's like a very specific theme. Something's working. I really want to push it. I didn't catch that during pre-market. That I looked to bump that risk, and my trading partner was fine with it. And so we bumped the risk a little bit. And on the open, we do a lot of open trading, very like specific in the scenarios we're trading. I was only thinking about the max amount of shares I can get. Every day for the last 2 months, all I've been thinking about is how can I be net long if this were to happen while managing my risk. That wasn't a part of my mental process that morning. And like I say here, the only goal in this period is to manage risk. So any trade decision or execution decision that goes against what the data just shows and everything we've talked about, the whole system is going to turn into negative expectancy when those mistakes come into play. So if I ask myself if I repeat this action 100 times, same exact, because we can get to the point of specificity to say this same exact market context, same exact data, same exact setup, is this the right thing to do? No. Max really need to lose 1 R, and we mitigate our losses very tightly. So 0.5 R mitigated loss is very reasonable in this. And my mistake in expecting this to trade differently and getting that momentum size without confirmation, losing 1.8 R, it's nothing like insane, but you repeat that mistake in an environment like this, like it's going to be a drawdown we cannot come out of if we're going to continue to make mistakes like this. But yeah, that's the overall.
What about?
I think that's pretty much it. The mistake is oversizing and letting the expectations come into this trade. It shouldn't happen. It's a mistake that I worked hard to get away from, and it just doesn't need to happen when you're being as specific as this.
It isn't Apple. We know that company pretty well, but we'll talk about the big picture first. So at this time, the major indexes, the SPY and the QQQ, they've been uptrending throughout the year, and they've been very steadily uptrending since the pullback in February and March. And prior to this day, the SPY and QQQ have been making new 52-week highs the last 6 sessions in a row. Here's some other background on Apple, as well as the catalyst that drove this trade.
So we'll give you some scores as we're going along. I would love for you to add the key technical level support and resistance to your big picture slides.
Okay.
So you have that handy. So we're going to go 8 out of 10 on that.
Okay. Like I said before, Apple's a pretty big company we both know about. They're in tech, computers, phones, headsets, even rumor about cars. And in the case of this trade, they announced that they are getting into the AI space with their new product, Ajax, which is nicknamed to be the Apple GPT, a large language model. And so upon the trade, they announced this news that they're in development of this software or product, if you will.
Yeah, this is a 9 out of 10 on stock selection. This stock just hit the wire with this news. This is breaking news and important breaking news. Good trade, good stock selection. You can build a career out of this trade alone. A breaking news trade, you could make yourself into a 8-figure a year trader if you got really good at it.
So the technical analysis, Apple, they've been in an uptrend, but more so going along with the market, going along with the SPYs and the QQQ. They did announce and preview their VR goggles recently, but that's been getting some mixed signals in the market. It didn't really create a lot of buying. But today's positive news brought us to a new 52-week high.
Yeah, again, I want you to show me the important level of support, resistance, and denote them on the chart. We're going to go 8 out of 10 in technical analysis.
So the day of the trade, Apple began trading just kind of normal in its range, not going in a certain direction, so to speak. But when the news did hit, we did see a huge spike in volume prior to the trade. So the first 2 hours and 32 minutes of the day, we had traded a little over 66,000 shares. And then in the minute of 12:03, we traded 2.2 million shares. So something was going on. As well, we can see the SPY and Q charts. They also got a push in the direction when this news hit, especially the Q chart. But more so, this is a good guidance to see if there's going to be some continuation with this trade. So this is a breaking news trade. So your news source is probably the most important. Not only that it's something accurate, but also something that you're getting quick. You want to get it's breaking news, right? So this isn't something you want to read about the next day or in a few hours. You want to hear about it the minute it comes out. In this case, the news was actually found by another trader on the desk, which is something that we do as a team. And if someone sees something first, we share that so that we can all share on that opportunity in our different styles of trading. Kyle, I believe, who called this out. And I think that there was a few other traders that were able to get some good trades out of this. So once you have the news, obviously you want to analyze the news because news isn't always good news. Sometimes it's bad news. And so when looking at the news, you want to also, besides taking note of the market reaction, you should have your own opinion, if you will, on what the news actually is. And we use a system of a 0 to +10 or a 0 to -10 to grade breaking news catalysts. And closer to 10 on both ends is something that should create a stronger market reaction. Once you have the news and you've analyzed the news, then you should be looking at the reaction and see how the market is taking this news. In the case of this strategy, it was positive news, and we saw a big buy pressure immediately in Apple.
I think this is a 7 out of 10 in terms of your trade strategy, and I want to help you understand why. So if I just take a half a step back, this is a terrific trading strategy. This trading strategy is one that is deployed by really great traders in our space, really great prop traders. Some of the best prop traders in our space trade this strategy and only trade this strategy. This is totally worth exploration and study, and it's an excellent job by you reviewing and understanding this is super important. You can make your career off of this trading strategy. I highly encourage you to continue working on getting better at this strategy. If you learned nothing else as a trader, you could be a professional trader deploying the strategy. You could do it with discretion. You could build automated models for it. You are in the right spot. Highly profitable strategy for you. Breaking news strategy trader. I don't want to kind of give away some of the secret sauce about this. Is like one of those trades I feel a little bit funny giving away too much information on. So I want to be sensitive to some of the other guys on the desk, and this is a competitive trade. But in terms of the trade strategy, I do think you need to understand that there's technology that needs to get built to make sure that you're getting news headlines that are meaningful to you. All right, so it's not just that you have a good news source. You need to build technology to help filter the news sources. And I'm going to leave it at that. Okay, that's where I feel a little bit funny talking further on that. But you're going to need a little bit more on that. You're also going to want to be pretty specific about how you will exit and enter the particular trade. There's going to be different types of trades you're going to take. There's going to be certain trades you just take right away off of the news. There's going to be certain trades you take off of the news plus seeing certain things from the price action. There's going to be sizing rules that need to go into this. There's and so you got to be more specific here with your trade strategy. And so that's going to do that. So good start for this. But as you trade more of it, we'll talk some more about that. Does that make sense?
Absolutely. Looking forward to it.
Okay. All right. What else we got?
So going to actually how I handled the trade.
Okay.
This is the chart of my entries and exits. So upon getting the news and pulling up Apple, I just saw this exponentially large volume bar of buying pressure and this huge green candle. And as well as the buzzword AI and the reaction that's been having in other names like NVIDIA, and that's been really driving up prices. So I got in right away, and for the strength of the volume, I chose the midpoint of the candle I entered at as my stop in case the news wasn't so positive. I wasn't risking too much. And So we kind of struggled. Well, didn't super. It wasn't like a kind of struggle, but there was some hesitation going into the above the 196 level. So I did reduce some of my position right away, and as well in the really very fast pullbacks that you can see on the tape. To my level of trading, I was playing it more safe than sorry. And then as this was set, I set limit orders to sell pieces of my position at notable places. So for example, at whole dollar marks, so like 197, 198, and I got out most of my position there. We went through a little bit of a pullback, a little tiny consolidation, and we saw some continued buying. I thought maybe this had some more room to go, so I got long. I added some more, and we started to break down from there. So I started to exit my position and got all out.
There's a lot to talk about here.
Okay.
I think in trade management, that's a 7 out of 10. One of the things that I probably should mention from your trade strategy is, and that could go in your trade strategy, this could go in your trade management. We have to be talking about game planning. So I remember being in the room behind us and us talking about the Microsoft news about its release for its AI revenue generating products.
Yes.
They introduced 3 new packages that people could pay for. And particularly these would help companies be more productive and individuals be more productive. And you have this ability to use AI tools inside of your Microsoft tools and make yourself much more productive, make your company much more productive. And we remember trading that and remember the market reaction to that.
Yes.
Super positive.
Yes.
People were surprised by how much it went up. People were surprised by how well it held up. That was a changing fundamentals trade, as we say on the desk. A new product, a new revenue stream was introduced by Microsoft. There were 3 new real products. There are real people that they could sell that to. It was very easy to see the through line to how they'd be making more money. Okay, Microsoft's a real company. This is a real product. We're really now creating a roadmap to making money in AI. We're not just talking about potential growth. We're not just being speculative. This is real. And it traded really, really well. All right. And so I remember sitting in that room saying to you guys, let's remember this and let's start to think about what might happen next. And I remember saying to you guys, there are going to be announcements going forward from other companies that talk about products that they're going to be releasing. There's going to be smaller companies that talk about how they're going to support these products. And you want to game plan. We didn't actually go through a very specific game planning exercise. We've done that in the past. But we talked about how you want to be game planning what's next. What if Google makes an announcement that they're releasing real products? What happens if Apple releases that they're offering real products? I think we're a little bit short on time, so we just sort of introduced this idea that they're going to. We didn't really sit down, which we do in the future, and what a breaking news trader does. A breaking news trader would take, and look, you're a junior intern, so I hope this is coming off the right way. A breaking news trader would take that Microsoft day and would sit around with his or her colleagues and start to say, what's next? What could be announced in the future and by whom? And how meaningful would that be? If Microsoft announced future products, what future products would really get the market interested? If Amazon did, what future products would really get the market interested? If Apple did, what would get the market really interested? If a smaller company did, what would get the market interested? What would be released that wouldn't get the market interested? What news releases would be for us to fade? And you'd work through that and create these roadmaps for things that are potentially to come. So I think in your trade strategy, that's probably going to be a part of it, which is I game planned a scenario of Apple coming up with a real product, and if they came up with a real product, I would expect it to go up this percentage. I'd expect to buy it here, risk this, and work through that. If somebody made an announcement but it wasn't a real product, here's what I would expect it to do. All right, so game planning is a big part of that. And maybe I should spend more time with you guys after Microsoft going through a very specific next announcement instead of being so general. So I'll work on that for myself. But that's got to be a part of your strategy here. I guess what you're saying here in your trade management is you're getting in above the first green candle. That's your entry, or that's just what you did.
I'm in on that first green candle.
You're in on the first. Are you in at the? So are you in at the bottom of the first green candle? I mean,
so
are you in at the top of the?
So I first put an order out at the bid that doesn't get hit, and then I get in at the offer, and then I get hit on the bid. So,
but more towards the top of the green candle. So we're pretty far into this move.
Yes.
So that's where we got to be thinking about our trade strategy. What's too far? And if I'm too far away from the starting price, how much of an ATR am I willing to pay? How much of a spread am I willing to pay? What's too far away from the undisturbed price? You guys have been using that term a lot these days. I'm not sure who's been talking about that a lot, but you guys like, so we'll use that. It's a good way to, it's a good word to use. So the undisturbed price. Now that's got to be, I think, part of the trade strategy, and I think that's going to be part of the trade management. How far away are we from the undisturbed price when you bought it?
We're 2% away.
Okay, 2% for the stock.
Yes.
Okay. So I think you want to think about, that's probably too far. What you probably need to be thinking about then is, if I do buy it up here, it can't trade against me. If it's too far away from price and I get in, it really can't tick against me too much. It's too far away from price. I need some sort of consolidation and some time for that consolidation to go sideways and trade for the second up move. Or I have to just let it go and try and buy some pull in later if I think it's going to follow through. So you want to be thinking about that. I mean, the way that people make a lot of money is they get in pretty early for something like this. That's the first way you make a lot of money. Second way is you're very systematic about how you get in. The third way is you buy a pullback in a systematic way. Those are 3 ways to make a bunch of money. So, okay, so those are some ways that I'd improve that. Good, but I mean, this is a good stock you're in. I mean, this is where the action is. This is very good stock selection. This is a good trade.
Thanks. So the next slide is about the technology. This is less about digital technology than it was about hearing someone else on the desk. But that being said, they heard of that. They got the news from the internet. But also what also brought Apple to my attention simultaneously as hearing the news is the insight that its RVol was in the 3000s in that moment. So for Apple to be trading on that larger volume, that just brings a trader's attention to it right away.
Anything significant for reading the tape?
Potentially where the stock drops off and turns.
Okay. For your exit.
For my exit and for knowledge of how this breaking news trade traded. And we fail to break 198 again.
All right, so you're watching that 198 level?
Yes.
Okay. So can't make a new high. You expected it to make a new high there above 198?
Yes, I did. I was looking for another leg up to potentially hit $200.
Okay.
And here it speeds up, getting closer and closer to, and breaks 197.
So you're seeing a change in the tape here. Are
Absolutely.
you using this to exit?
I'm using this to exit, and I'm also using this information to see if it's another good trade to go short. We find a little bit of maybe we can hold it, but not at all.
You're looking for that 197 to hold,
Yes.
and it's not.
And I'm all out.
Okay. All right, good. Yeah, I think that's a 9 out of 10 on reading the tape. I think you do a good job there. Seeing a double top. I think you see the weakness coming in on your tape. Think about an exit. Think about a definitive exit strategy that you can develop as well, not just softness on the tape. But you do see that softness on the tape. Didn't make a new high and started to trade down a little bit. That's significant. That's a reason to get out on a trade like this. All right, 9 out of 10 for that. Trade review.
Yeah, so I would make quite a few changes. I'd say a lot of them are in line with ones you said. Definitely my entry could use improvement and need more planning. I definitely get that. I also think myself personally could have understood the catalyst more instead of just basing it on a positive catalyst or just basing it on the fact that it's positive. Like we said before, this case isn't like Microsoft where they're planning to sell something. This is just an announcement that they have something in development. So there really wasn't anything that's actually changing the way Apple does business or a way that they're going to be making more money.
Microsoft had 3 real new products.
Yes.
It had 3 different price tags on it. The head of the company was out there talking on CNBC about these new products. It was real. Products were real. This was, hey, we're working on something.
Exactly.
That's different.
That's different.
That's probably pop and fail. And that's why we talked about game planning, because we're gonna see more breaking news trades that follow through when they've got real products, and we're gonna see more of these, hey, we're working on something, pop and fails. And actually, what's gonna happen is, for the latter, the pops are gonna be less pronounced, and they're gonna fail quicker.
Because we're getting this news on a more regular basis.
Yeah. Market learns quickly. All right, good. So just go back to that.
Yeah.
So I say this to you guys a lot. I think you want to point out what you do really well in trades and build on that. You do something here really well. What is that? I don't see it on that slide. If you had to compliment yourself, what did you do really well here? And that's got to be in a trade review.
I recognize the trade.
Okay.
I know what I did wrong in the trade.
Okay.
So I can improve in this trade.
There's something you did really well here. You haven't quite hit on it yet. Super important to build a trading career.
Well, I read the tape well. That was a 9 out of 10. I don't know, Bella.
So what you do really well here, and this is super important, is you identify a trade that you can build your career around. You're not just reviewing a trade that worked. You're reviewing one of the better trades from that week. And one of the guys on the desk made a quick 40 grand long. Would have made a lot more if it followed through off of this opportunity. We talk about reviewing easy money trades. So at the end of the month, a bunch of the guys develop easy money trades for the month. What are the trades that had the most opportunity that was easy money? And they go over them. This is an important trade to review. This is something you can build your career around, and you have identified that. There are times we sit in these rooms and we talk about good trades, maybe very good trades. Like, this is a career building trade in a career building playbook sector. And so of all of the trades, you're new to this. Of all of the trades that you could have reviewed, you found one of the really good ones, really one of the best ones, and are working on that. And so you do that really well. All right, trade review. So I've got 9 out of 10 on stock selection, 8 out of 10 on big picture, 7 out of 10 on trade strategy, intraday fundamentals, 9 out of 10, technical analysis, 8 out of 10, reading the tape, 9 out of 10, trade management, 8 out of 10, technology, 8 out of 10, review, 8 out of 10, and diligence of presentation, 8 out of 10. 82.